Happy Tuesday. Hope you had a fantastic 4th of July weekend, and we're really excited to have you. So aside from running my own startup, one of the things I lead here within Everything Marketplaces is fundraising. And for the most part, right, a lot of the early stage founders that we have joined the call are in a different path than you were when you decided to fundraise, right? Like very, very seldom is the founder first raising after they bootstrap for 6 years, put in a lot of blood, sweat, and tears, and gone to, I think, the point of doing 40 million in GMV, right? So I'd be curious, as you sort of thought about that, right? Because I'm assuming, back in 2008, you sold your business. So you probably put a lot of equity, a lot of capital in bootstrapping your business. And then how that mental shift was of like, hey, here we're running a profitable business now. We've grinded sort of our way to this point. But now, pun intended, like now it's this idea of, rather than staying small or staying sort of boutique in that nature, that will continue to grow and, feed the bottom line. We're going to grow the pie. We're going to bring individuals on that are going to help me sort of grow myself, right? And become, and really, I think, seize this opportunity. So would love it if you could just dig in a little bit more about that psychology. And then also how you thought about, the valuation, because I think that's one of the things that's also tricky for us, right? As early stage founders, folks are in different stages, and some folks that are doing traction, how they thought about sort of that valuation. I'd be very curious for you, right? You were at a very high sort of point in how you thought of valuation for that initial round. So
yeah, no, it's all good questions. I think I'll break it down into sort of the fundraising side and then the mentality side. I'll be honest, I didn't know what VCs were going into 2015. I literally had no idea. My prior business, I bootstrapped all the way through. I sold it to a public company out of the UK in the middle of 2008. By the end of 2008, most of my equity that I got for the sale was almost worth nothing because of the financial meltdown and sort of a similar crisis that actually probably was much worse then. But and so, yeah, starting my pizza slice was truly bootstrapped. I didn't really put a lot of dollars in. What I did was I made sure that, again, similar to my prior business, that from day one, I had a product I can sell, and that if I sold one, I would make at least 50% margin. So if it cost me $1, I would sell it for $2, and then the idea was doing that as many times as possible. So profitable unit economics from day one. Those are the only businesses I would ever get involved in. Like, I think the idea of, building and getting customers and no one's paying, or maybe they're paying, but they're paying 80 cents on the dollar. And maybe unit economics will change once you get scale. Certainly some companies have proven that to be valuable, but I would say it's an incredibly difficult proposition, and not the way my brain works. So I would say from day one, bootstrapping was all about, again, how much is it costing us to do one website, build one website, process one order, and then what do we want to charge? We realized it was costing us about $1. It was like 80 something cents. And so we charged $2 per order from day one. So it's $2 per order. Cost was 80 cents, and we were just doing that as many times as possible. With scale, our cost has come down, and we've kind of maintained the same pricing. Our pricing today is $2.25 per order. Like, we have barely raised any pricing. And so that was really helpful. When I went to raise money, again, it wasn't really to raise money. It was more to get people involved that I really liked. And then they started educating me on the importance of raising capital and introduced me to some VCs. And the lessons that I've gotten along the way that I had to somewhat blindly trust in order for them to happen was, like, valuation matters, but it doesn't really matter. What matters the most is the quality of investors and how clean the terms of the deal are. The quality of the first investor and the quality of that first term sheet sets the stage for all future term sheets. The moment you give in on terms on the first term sheet, you have to assume that those same terms will be applied to all future rounds. And if there's liquidation preferences, if there's like kind of wild stuff on there, that's not founder friendly. Two, again, the quality of investors sets the tone for what kind of company you are, sets the tone for what kind of investors and what kind of customers you will attract moving forward, sets the tone for what kind of talent you will attract. We were really fortunate to work with Primary Ventures, which is incredibly well known as an early stage backer in the New York ecosystem. I mean, without Primary on our cap table, and without some of those seamless founders on our cap table, I don't know that we would be able to raise money from GGV Capital, which also is a top-notch investor, and then KKR Growth, their TMT fund. So what I know is along this way, I really didn't go crazy trying to optimize valuation. I certainly didn't want to give away my company, but our valuation at that like seed or pre-seed round was, we did a note of $1 million at 15 million pre. 15 million post. So 14 million pre. And we were doing 40 plus million in GMV annually. Like, that's a really favorable round, but I didn't raise a lot of money. So, I was basically giving away, something like a little less than 10% of the company. And then our second round was 3 million on 30. So another 10%. And then our third round finally was 15 million on 96. And so all of these were possible because of the quality of the investors, but also we didn't get ahead of our skis. The one thing to remember is if our first round was 1 million on 30, we would not have been able to raise our second. Or our second round would have been a flat round anyway. And so you're diluting yourself eventually anyway. So what you have to do is kind of look at it from where do you want to be in 5 years? How many rounds do you think you'll need? Be very honest with yourself with how fast you can grow based on each round of funding. And then raise a very fair round every single time. Don't chase valuations. Because unless it's like your pre-IPO round where it's the last round you'll ever raise, eventually it'll all even out. You may pull one on an investor in your seed round and get a 30 million valuation and you can be really happy. But now you're on the hook for that growth. And I mean, I probably only see less than 1% of companies pull that off. And so by the time your second round comes around, so let's say you're a Series A, well, now you're on the hook. Now you need to raise money. You probably need to raise, more than 1 million, let's say 3. Or, I mean, now Series A rounds are 10 or 20 million, which is wild. But then you have to deal with the consequences of the valuation in the round after. So I just, again, I've been fortunate to be surrounded by great people who have given me great advice, and I've been trusting of that. And again, I would say the most important things are be really fair in your valuation. It really doesn't matter that much. By the way, let me give you a scenario. If my first round was 20 million instead of 15 as a valuation, and you're raising $1 million, the difference in my ownership would be a little over 1% difference. So it'd be the difference between me owning 91% and 92%. Think about that. That's the difference, because amount of capital raised matters, right? And so, $1 million on 15 or $1 million on 20, if it means I'm getting a much better investor at 15, and all I'm doing is giving up 1% to do that, to secure quality talent, quality future investors, and a clean term sheet, I mean, I would do that 100 out of 100 times.